Hi, I'm Richard McNeely, Managing Partner of Daines Accountants. We're here to discuss succession planning, and I'm joined today by Roy Farmer and Trevor Shaw.
I'm Roy Farmer and I'm a partner here at Daines and I lead the corporate finance team.
Hi, I'm Trevor Shaw, I'm a tax director here at Daines and I work with Roy to structure transactions to minimise the tax liabilities so that the owners keep as much of the cash as possible.
So right then Roy, let's dive straight in. I'm an owner manager.
Yeah.
Explain to me, what are my options when I'm thinking about exiting the business?
Okay. Well, what I would say is it depends on your plans, how long you want to spend in the business before you ultimately retire. For instance, if your goal is to run the business and then at some point pass the shares on to other family members down a generation, then the thing that I would say is that it's vital that when that business owner comes to retire or to start to step back from the business, they have in place a strong management team that can run the business independently, because that's vital to ensuring the business can flourish in the future and retain its value. If, though, the business owner has got maybe a shorter term view and wants to sell and realise capital value for their shares, they have a number of options. The obvious ones would be a sale to a trade buyer, or perhaps to a management team or to family members. We deal with all those types of transactions, and the structure typically is that we'd seek to achieve a large level of cash at completion, but there may be an element of deferred consideration in there as well.
Okay Roy, so some good points there, but as a business owner, when should I start thinking about succession planning?
Simple answer is the earlier the better. We meet many business owners who approach us who perhaps want to sell their business quickly through retirement or ill health, and that's fine, but it limits your opportunity to explore options and perhaps make certain changes to the business which would have maximise the value to them. We'd much prefer to have early conversations well ahead of when an owner plans to exit. It allows us to explore options and illustrate what might be possible, allows us to understand what's important to them in terms of perhaps maximising a return through the ownership of the business and then what they want at the end when they sell. It allows us time to perhaps give advice on what things it can change within the business to help maximise the value that we'll ultimately achieve. Because for a successful sale, it's all in the planning. The more we can plan, the more we can think things through, the better the chance we have of selling the business at maximum value. The added benefit is that if they get an opportunistic approach from a buyer at a time not of their choosing, then it's likely the business is in much better shape to be able to have that conversation and perhaps enter into a transaction a little bit earlier than when that business owner would have otherwise have planned.
Yeah, because when that happens, it's still an opportunity to extract optimum value.
Oh, absolutely, because it's often the case that when approached by the opportunistic purchaser, they have a need for your business, and if we can capitalise on that and be in good shape and be able to present the business in an attractive fashion without perhaps a lot of loose ends knocking about, because we'll have tidied them up at that point, all the better.
Yes, okay. So this is sounding better already then, Trevor. So how should a business owner go about maximising their returns from the business?
It's a very interesting question, and when you're looking as a business owner, then you need to consider what the time horizons are for the business owner. If their intention is to pass the family business on to the next generation, then they're probably looking at how they draw income out from the business over the period until they retire and possibly past that point. If they're looking to sell the business, then it's a combination of how they draw the funds out now and how they draw it out on a sale and how far off that is. Now, generally speaking, the tax rates on a sale of a business are significantly lower than, say, on salary or dividends. So if it can be back-ended, that's great, but obviously people do need money to live. So it is a question of a case-by-case, looking at what the individual circumstances are to identify that. But also if you're looking at an exit down the line, or you're looking at increasing the value, increasing the rewards, the cash generation in the business, you need to look at the things the businesses can do to try and achieve that. So that could be leaving some cash in the business to invest in organic growth, or potentially looking at an acquisition of a business going forward. Another area where you can look at to try and increase the value or generate extra profits in the business is the retention of key employees. Those people who, if they left your business, would cause you a major problem. Whether it's a sales director, engineering director, somebody who is really important to make sure the business has a top value.
And this is a point that's often overlooked.
It is, and it's certainly, individuals are undervalued, or it's thought about too late. It's thought about when the guy's already on the way out the door. Now what you can do to incentivise somebody like that, say, is give them a cash bonus, Or alternatively, you might want to increase the value of the business, so you might want to try and give them an equity stake in the business, so some shares. Now, there is something called the Enterprise Management Investment Scheme, which is a government-approved scheme, and that enables you to give an employee the right to buy shares at a future date. And that date could be the sale of the business in, say, 5-6 years' time. Now, the idea is you agree that they have the right to buy the shares on the sale, but the price is set today. And often that can be at a discount to the full market value of the business. And when they come to sell their shares down the line, say they paid £5 a share now, they might sell their shares at £20 a share. They'd make £15 a share. That's a good incentive for them to remain in the business. And on top of that, they may only pay 10% tax on that £15 profit. So that's a very good result for the employee. And for the business owner, hopefully, as a result of that, the individual staying in the business has had an impact on the value of the business. So although the business owner may have given away 5% of his business, hopefully it's worth significantly more, maybe 110, 115% of what it would have been without that employee. And therefore the business owner is significantly better off as well. So it's a win-win for everybody.
Well, thanks, Trevor. Some useful information there. But Roy, how do we actually go about valuing the business itself?
Okay. Well, as you know, there's a separate video on valuing a business, but in summary, a commonly used method is to apply a multiple to the profits of the business. Now, first of all, in terms of the profits of the business, if you've got a business that perhaps is sort of low growth and relatively flat profits, it's probably fairly easy to establish what the profitability of that business is. But for many ambitious businesses that we work with, there's lots of investment going on within the business and growth to follow. So the objective for us when working with business owners is to present the business to a buyer and present the best and most attractive profit number. So that might not necessarily be the historic profit that's been achieved, but perhaps maybe a run rate profit or a forward-looking profit, which the business can say with some confidence it's expecting to achieve. Now, in terms of the multiple that's applied, that can vary widely, but some of the reasons where we can get a high multiple would be if the business perhaps is in a strong growth sector, has some unique products, has got a good position in its marketplace, strong barriers to entry, strong management team. All of those will help that business owner maximise the value that they're likely to achieve from the sale of their business.
Yeah, and I suppose the other thing to say is there's always exceptions to the rule. I'm thinking more of tech businesses and the like.
Yeah, so there may be very successful businesses that aren't making a profit because they're investing all of their profits back into the business. Undoubtedly there's a slightly more tricky to value, but you're then looking into the sort of the projections of the business and what the business is likely to make profit wise in the future. And you mustn't forget that in terms of selling a business, we're always looking for that strategic buyer who can see the opportunity, whether it's an opportunity today or in the future, and therefore hopefully pay a premium to acquire that business.
Okay, well that's very useful. Now we touched earlier on management buyout transactions, and the question I'm often asked is how do we fund an MBO?
Yeah, and I'm often asked that as well, because a lot of business owners will tell me, well, that my management team don't have any funds, so how could they possibly buy the business? Well, management buyouts have been going on for a long time, and there's a fairly tried and tested way to structure these transactions. We've got access to lots of different types of funders, whether it's sort of high street banks, more specialist asset-based lenders, private equity investors, and then there's a whole myriad of other types of funds that we can tap into. And dependent upon the business and the opportunity, there'll be many of those options available to us. What we often find with management buyouts is that there may be a shortfall between the amount of money that we can raise and the amount of money that the business owner wants for the business, and that's where deferred consideration comes into play. That may be in the form of a loan which the management team would pay to the owner at some point in the future, or the vendor may even retain a stake in the ongoing business.
Okay.
So there's various methods with which to bridge that gap between the value and the funding that's available.
Yeah, but the key message is you don't need to be a millionaire to buy a business.
Absolutely not. We try to create millionaires within the management teams, but they rarely start that way.
Okay, great stuff. Now, Trevor, so we've got to a point, we have a value, we've got a buyer, then we've got the dreaded tax to think about. So what are the tax consequences of selling my business?
Well, when the person sells their business, they're subject to capital gains tax, and the headline rate of that, the normal rate is 20%. Now, there is a relief called entrepreneurs relief, and that enables the rate to be reduced to 10% on the first £10 million of proceeds for an individual. So you could have more than one individual owning a business, they have their own £10 million each. So there's quite a lot of benefit there. But to qualify, you need to be selling a trading business, you need to own a minimum of 5% of the ordinary share capital and have 5% of the votes, and you need to be employed by that business, either as an employee, as a director or an officer. And you need to have satisfied all of those for the year prior to sale. If you do that, you have a 10% tax rate, and that's highly successful, highly efficient for people. Now, Roy's mentioned about deferred consideration. Now that can make things slightly more difficult on the structuring. So, for instance, they're going to get some cash now and they get some cash in the future. Depending on how that's structured, the cash now might qualify for 10%, the cash in the future might qualify for 20%. So obviously there's a tax loss there. If structured correctly, then all the cash can qualify for 10%, but it does need us to be in early to be able to get the structure for the transaction correct.
Okay, so some careful thought required. Now, Roy touched on family businesses and passing shares from one generation to another. Explain.
Again, it all depends on the circumstances of the family. So dad's got shares in the business, he's looking to pass that on to the kids. Now, the big challenge here is, what is the aim to do with the business? Is the aim that the shares are going to be passed on to the kids? The kids are going to run the business and it's going to stay inside the family for a long time? Or is the idea he wants to pass some shares to the kids, then sell the company, and it's a way of passing some value to the kids? Now that can work quite well, but again, it needs to be structured correctly, it needs to be structured in the right time. So for instance, if dad could qualify for the entrepreneur's relief at 10%, he gives some shares to his son who doesn't work in the business, son won't qualify for entrepreneur's relief, and he could be paying 20%. That gift has just cost them 10% tax. Also, if the intention is it's a long-term retention of the business, then actually dad might not want to give away shares until death. There are certain benefits of not giving shares away until death. One of the things for that is, for inheritance tax, there may be no inheritance tax bill. As a trading company, it qualifies for relief and is exempt from inheritance tax. But also, the value that the individual is deemed to have paid for the shares is increased on death. So if dad bought the shares for £5 and then on death they're worth £2 million, when those shares are gifted to the son on death, they're deemed to have paid £2 million for them. So they'd only pay tax on a future disposal on the amount above £2 million. If it happens as a lifetime gift, the odds are they'll be treated as having paid £5 for them. So in essence, you're potentially talking about, on the £2 million difference there, a tax differential of up to £400,000. So again, timing and advice is critical.
Wow, more complicated than perhaps it first appears. So Roy, in summary, we've covered quite a lot of ground. Your top tips, if you like, for succession planning.
Plan early. Think as a business owner, think about what you want to achieve whilst owning the business and ultimately on your exit. Try and work out what the exit's going to look like, who you may be selling to. Bring in advisors early to help you explore those options, but also plan for that point in time where you may get the opportunistic approach and be ready for it, because often those can be the most sort of attractive sale opportunities that you might see.
Roy, Trevor, thanks very much for your time. Thank you.
Thank you.